welcome everybody formally to today's discussion on exports in the new normal, a banker's perspective. Rubix Data Sciences is very proud to have two eminent and senior bankers with us today to discuss the situation when we talk about export financing. The focus today is export financing in the new normal. And we are very, very fortunate to have with us Mr. HSU Kamath. Mr. Kamath is an extremely experienced career banker, having entered the banking sector in 1973 as a probationary officer with Union Bank of India. He served in a plethora of roles and is the former chairman and managing director of Vijaya Bank and the former managing director and CEO of Tamilnad Mercantile Bank. During his banking career, he held very senior positions with Canara Bank and the Union Bank of India. By qualification, Mr. Kamath has a bachelor's degree in commerce and is a certified associate of the Indian Institute of Bankers. Welcome, Mr. Kamath, and thank you so much for agreeing to speak with us. Your experience in foreign trade financing will be very useful to us today. And our attendees are looking forward to hearing from you. Mr. Tanksale, of course, is not a stranger for anyone who is following Rubix. We are very honored and privileged to have him as our non-executive chairman. And he is one of the most senior and respected bankers in India, having been chairman and managing director of Central Bank of India and CEO of Indian Banks Association. He is a fellow member of the Management Accounts of India, so FCMA. And he's also a certified associate of the Indian Institute of Banking and Finance. And he has spent over 4 decades in the banking industry, during which he was part of senior management of 3 major public sector banks. He has been conferred with several awards and recognitions and has served on important committees of the Reserve Bank of India and Government of India. Serving on various company boards, Mr. Tanksale is also an advisor to Swift India, where he supports high-quality financial messaging services globally. At Rubix, Mr. Tanksale provides key strategic inputs and direction to all of us. So welcome, Mr. Tanksale, as well. And Mr. Kamath, Mr. Tanksale, thanks again for being with us and for agreeing to talk about export financing in the new normal from a banker's perspective. I think our attendees will benefit tremendously from this. So without further ado, I'll move to my first question, which says that, according to the World Trade Organization, global trade is projected to drop by roughly 19% in the second quarter of 2020. India's exports are likely to conservatively drop by 10 to 12% year on year during the current financial year, as per FIO. Indian exporters, therefore, are facing almost an existential crisis. In this environment, what are some of the steps that the Government of India and RBI, what are some of the steps that they've taken to help Indian exporters? And in your opinion, what additional steps can be taken to help exporters? Mr. Kamath.
Thank you for having me on this webinar. And also thank you for your very generous introduction. Before I start answering your first question, I would like to compliment the exporters community for the excellent performance on the export front. Compared to 1957 year export, which amounted to only about 59 billion US dollars, come financial year 2009, the exports totaled to about 327 billion US dollars. The numbers could have been better, but given the constraints under which the export fraternity is functioning over the years, this is indeed a remarkable achievement, and all the exporters deserve very rich compliments. It is true, as you said, that the global trade is hugely under stress. So is the case with Indian exporters as well. What initially started as a health crisis has today converted into an economic crisis all across the globe. The pandemic and the subsequent lockdown has led to cancellation of about 60 to 70% of the export orders. India's exports actually declined by about 36% in the month of March, 60% in the month of April, 37% in the month of May, and about 12.5% in the month of June. This indicates that the fall has been gradually slowing down. This is one positive. And in Q1 of financial year 2021, the merchandise exports from our country amounted to about 51.32 billion. Compared to the year-on-year period, it is less, no doubt. Exports, both including merchant exports as well as service exports, account for about 18.6% of India's GDP. And in that backdrop, you will appreciate that this is indeed a very important segment of our economy. Now, coming to what relief measures have so far been initiated by Reserve Bank of India and the Government of India. To recall some of them, Reserve Bank of India has already extended the export realization period from 9 months to 15 months for exports done till 31st of July 2020. Similarly, on the imports front, the payment for imports, which should have been normally made within 9 months, the period 6 months, the period is now extended to 12 months. And this again is for imports which are made till 31st of July. Similarly, the period of export credit has been extended from 12 months to 15 months, again up to 31st of July. I'm sure the 31st July being over and behind us, the regulators may revisit this relief sometime sooner than later. The interest equalization scheme, under which the exporters get 3% interest subvention, validity period is already extended up to 31st of March 2021. Similarly, under the ECLGS, 20% emergency credit is also made available to the exporter community as well. The segment which is under severe impact is the MSME, which contribute about 45% of India's exports. All these measures taken by Reserve Bank of India will bring a lot of relief to this particular segment. On 6th of August, Reserve Bank of India has come out with the much awaited one-time restructuring scheme, under which if the accounts are restructured, do not get downgraded into the non-performing category. While the circular from Reserve Bank of India is already published, the regulator has appointed an expert committee to look at some of the financial parameters and benchmarks, and I'm sure sooner than later they will come out with the final guidelines, and banks would be in a position to extend this restructuring facility and render help to many of the exporting units which are under stress today. What more can be expected from Reserve Bank of India? Maybe to further strengthen the relief measures, a relook at the non-performing norms, which currently is 90 days. Maybe it's a good idea to change it to 180 days for a period of next 2 years till normalcy, normalcy restores. Similarly, whatever I have mentioned about the extended period, which is valid till 31st of July, maybe the regulator can have a relook. The export caution listing of exporters in these difficult times, in my view, needs to be sort of an exemption given at least till 31st of March 2021. What can the Government of India do? one, release all the export benefits that are held up, wherever they are held up. Effect tax refunds which are not under dispute or which are not under the adverse attention of the tax departments. All such tax refunds be made so that the overall liquidity of the exporting community improves. We are aware that the Government of India has a EPCG scheme under which for capital goods imported, there is an export commitment to be met. Can the Government of India look at extension of the period within which the commitments need to be met, say by at least one more year? Can we consider some sort of a wage support for the exporters in the MSME segment in particular and others in general? We have our foreign trade policy for a period of 5 years, which is from 2015 to 2020. The extension whereof is still awaited. Can the Government of India extend the existing policy, and under the policy various export promotion schemes, can it be extended by another 12 to 24 months, by which time a well calibrated, well thought of, well considered EXIM policy can be put in place. The period from March to say till now has been very difficult period for the exporters and to all other businessmen in general. And therefore, when the banks assess the limits, this particular period from March to say July, can this be treated as a blackout period, and these actual sales or actual exports for that matter for the period from August to March be taken as the basis and extrapolate that to on a full year basis and assess the limits? Otherwise, if you assess limits based on projections for FY21, the assessment of limits may not be realistic in my view. This is an out of normal kind of a thing which has not happened in the past. Maybe it is worth having a look at this. These are some of the things which strikes my mind as to what the Reserve Bank of India and the Government of India can do. Government of India can still do much better. If there are any questions, we will take up in the course of our discussion. Thank you.
Sir, I really like the last idea. In fact, a lot of exporters have, and not just exporters, business people are saying, 3 months, 5 months are completely hammered. We are going to face pressure from banks on our limits. So I think a considered policy on that, using a sort of annual estimate, for these few months which have done badly, where people have done badly because of COVID, and looking at actual performance later will actually help in setting the right limits. Mr. Tanksale, would you like to add?
Yeah, certainly. I would like to first endorse the compliments which Mr. Kamath has given to the exporters community, and because both of us have been in the journey from early 90s, when the liberalization and the globalization was introduced in the country, and the various export benefits were given to the exporting community. And that was a time when we were working in the field, and we were constantly associated with all the export promotion councils, FIO, and supporting the exporters business. And I'm very proud to say that those were the days when you were finding most of the places made in India stuff. And I think the opportunity has come back now for the exporters community, that you can replace the made in China to made in India in most of the American and European markets, which I remember in 90s, early 90s, when we used to go to US or Europe, you will find only made in India. And that's what is the capacity of the Indian exporters. My only request to the Indian exporters will be that you all have been seeing the journey, the support which coming from the banking community with the government, very well articulated initiatives of your own organizations, FIO and various export promotion councils. But the only thing that you will be able to create a brand when you are sticking to your quality part of it. price part of it, I'm very sure that government of India is conscious, right from interest equalization, production linked incentive scheme, merchandise export scheme, now the ROD TPT that is coming, remission of duty and taxes. So I think that part, anyway, I am sure the system will take care. System cannot ignore it. But what is most important is that how can you create a brand by maintaining your qualities and create an impact and impression in the European and American markets that we are here to be re-recognized. That's what is my suggestion and request to the exporters community.
Thank you, sir. I'm glad you talked about the support from the banking community and the mutual dependence of banking community and exports, because my next question is actually around that. Mr. Kamath, both of you, and Mr. Tanksale, both of you have been very senior bankers. A lot of exporters have generally expressed over time a common complaint that the rate of interest that export finance gets from banks is too high in India compared with other countries. And this makes exporters from India non-competitive in global markets. Do you agree with this assessment, and what can be done in order to help our exporters?
I will answer this question in a slightly different way. I do agree that the interest rates in India are higher than the rates prevailing in the other parts of the world. But there are reasons for that. Higher interest rates, we must appreciate and acknowledge, are due to certain factors like inflation in India being higher. There is large, fiscal deficit in our country. There is substantial, government borrowings. This year it is 12 lakh crores in FY21. Central Bank of India, Central Bank of the country, which is the regulator, Reserve Bank of India, follows a policy of containing inflation, and therefore the decisions taken by Reserve Bank of India has an impact on the level of interest rates. And above all, the functions of demand and supply also determine the interest rates. Currently, the interest rate to the exporting community starts from 8 to 8.5% on export limits. As I mentioned earlier, there's an interest subvention of 3%. The exporters do earn a forward premium of around 3.8% as of now in US denominated exports. If we net off these two, the effective interest rate on export lending comes to say around 2%. This is one aspect. The second is, let us remember the government of India, the sovereign, today borrows money under the borrowing program at the rate of 5.8 to 6% depending on the tenor. If the sovereign pays this kind of interest rate to the general public who are borrowers from the bank, there will certainly be a markup based on their credit rating, risks associated, etc. So this is one aspect we should all keep in mind. As we speak today, the consumer price index as of June is, which is the inflation index, is around 6.09%. And we should not forget the depositors community, because it is their funds which the banks on lend. So depositors will always expect positive real interest rate. That is the nominal interest rate minus the inflation. The net should be positive for their savings to be remunerated properly. Current inflation rates has taken the present interest rate on current inflation rate has taken the real interest rate to the negative territory. Unfortunately, things may change. If the inflation falls, the real interest rate again can come to the positive territory. But we should all acknowledge the fact that along with other factors, interest rate paid on deposits will determine the bank's lending rates as well. Therefore, there are limitations. There are limitations on the part of Indian banks to bring down the interest rate. And we should also remember, before I conclude, there is a window for borrowing in foreign currency for the purpose of exports, linked to LIBOR rates, and the markup over LIBOR. Even though I'm a banker, I'm saying this. The exporter should learn how to very skillfully negotiate with the bankers. In short, in my view, the interest rate on export credit is not that exorbitantly high. Things could be better. Interest rate can come down over a period of time. Thank you.
So I would like to supplement Kaushal. See, one is the spread on the exporters lending is the least in the banking industry. Let me tell you, my spread on the exporter and my spread on the normal lending is very different. For the simple reason that from the exporter, we have other income also, which is a fee-based income we call non-interest income. Very rightly said by Kamath that the interest has a direct bearing on the forward premium. And if the exporters are really, taking a forward cover for their future realizations, that interest differential obviously is available to them because the forwards are normally determined by the interest differential between the two countries. And thus that obvious benefit will be there. That does not mean that we deny that exporters should not get the benefit. I'll appreciate if as I said, the cost part, the price part, it is the system which should support the exporter to remain competitive. Otherwise, expecting the exporter to contribute to the country's kitty today, $500 billion. We have seen the industry when 31, 37 was the fixed rate, and hardly few billions were there in the coffers of the government. Today, with $500 billion, we are in a position to negotiate the things. The rates are the only thing. The exporters should not wait for the favorable rate to come. If they want to really, do their cost benefit properly, the right way is to hedge and earn that premium by the forward.
So sir, that's exactly what I was saying. From what both of you said, there are two things that come to mind. One is, of course, the interest subvention scheme. And the second that you mentioned is essentially using, exporters like to keep open positions because they think that, rupee will always sort of depreciate. And that's going to be a challenge. So when you do your hedging right away, when you book your forward, you're saying that effectively, Mr. Kamath, that's about a 3% this that you're getting, right?
If you take into account the interest subvention of 3% and the current forward premium, of course, which can change, as we move forward to the better or to the worse, the net interest rate comes down to about 2%.
So I think this is something that our exporters should take away from this discussion. And, if you effectively use, one, of course, interest subvention, and secondly, what Mr. Kamath and Mr. Tanksale have suggested in terms of, forward cover, I think you will be able to bring down your effective rate of borrowing to 2%. It is sometimes our desire to keep positions open which creates a bit of a problem in our financing. So I think that's I
have one more point to suggest to exporter, that yes, the interest cost is just a minuscule part of your total cost. Now there are various other costs which are involved where you have to look in that how can you bring the cost efficiency. It's related to procurement of raw material, using technology, conversion of raw material into finished goods, using efficient logistics. There are a couple of areas where I'll request that we should look into. But as a banker, we are with you that if you want to push the exporter, you have to remain competitive. That's we are definitely with you for that.
Yes, Mr. Ravish Kumar of Union Bank of India sent in a comment that, sir, moreover, ECGC cover is there for banks to reduce the cost of capital and lending. Just as a, that's the comments that are coming. You know, Mr. Kamath, you mentioned something very interesting about, borrowing in foreign currency for exporters. Why are Indian banks, and I am generalizing here, but just I'm saying on scale, why are Indian banks not able to lend to exporters in foreign currency in a big way? I mean, at scale. Many Indian companies have therefore then resorted to ECBs, external commercial borrowings, in the absence of being able to borrow meaningfully in foreign currency from Indian banks.
We must, appreciate the fact that Indian banks' balance sheet is denominated in Indian rupees. We are not a dollar-based, bank. In general, the commercial banks in India. The foreign currency pre-shipment and foreign currency post-shipment lending which the banks do is out of a pool of foreign currency resources, which is made up of FCNRB deposit, exchange earners, foreign currency accounts, deposits, which we call, EEFC, returning Indians, foreign currency account, and the foreign currency balances held in, some of the designated escrow accounts which are permitted to be opened under the, exchange regulations. So this pool is actually limited. Out of this pool only, the lendings can be made to the exporters. Of course, now Reserve Bank of India has permitted banks to borrow from overseas for on lending to exporters. This is the second source, that is available. The third source that is available for the bankers is to convert the Indian rupees into US dollars, generate US dollars through a, buy spot, sell forward kind of a swap. But this has a limit. It has to be managed within the aggregate gap limit, approved for, individual banks. Therefore, the overall foreign currency kitty available to the bank is not unlimited. It is limited.
Right.
And therefore, the ability of the Indian banks to lend in foreign currency to that extent is, constrained. But the situation today is much better than what it used to be, during the earlier years. Very often, one wonders. Mohan mentioned that the country has today forex reserves of more than $500 billion. Exporters might ask a question, then why not use this, a part of this at least, for export funding or for infrastructure funding, so on and so forth. As a junior officer in the bank, when we were working in the field, we also used to ask this question to ourselves: why is it not happening? But it cannot happen because foreign exchange reserves are not meant for that purpose. Foreign exchange reserves of the country, which is today $500 million plus, is to use in three eventualities according to me. One is to manage the exchange rate through the regulators' interventions periodically, so that the exchange rates don't go too much adverse or too much favorable, and to manage the exchange rates. Third is these reserves are an insurance against sudden huge outflows from the country for whatever reason. If those triggers happen, there is an outflow of foreign currency from the country. So this is to guard against that. This is the second reason. The third, of course, is to build the image of the country. We all know in 1991, our forex reserves were just enough to cover, 2 weeks, imports. Today, it is more than 15 months or so import, coverage is available. So therefore, these are not available to the banks for the purpose of, on lending. These are meant for a different, purpose altogether. So therefore, we need to work within the foreign currency pool that I have explained, earlier. Thank you.
But I would like to supplement here that I don't think there is a gross denial to this opportunity, and banks would be more than happy to use their reserves so that to that extent, my own exchange risk I'm covering, to be very frank. So I don't think that there could be denial. There could be an issues of credit appraisals, or I don't know whether all exporters are really looking for a foreign currency loan, because every exporter is very, very careful about the cost part, because once you get into foreign currency loan, you are straight away losing the benefit of the exchange movements.
Correct.
So because I have worked in this field for full 6 years in the branches, and I have seen that every moment people would like to make the best of the situation. Now,
Correct.
my request to exporter is that you can't have a cake and eat it too. So your differential should be on a trade, and the exchange benefit should be eventual. But if you blend it properly, that is what we used to suggest to a customer. यार कम से कम 50% तो cover करके रखो. So so if you blend it properly, I feel that people can go. We have worked extensively in the diamond market when every transaction will be matching transaction, that they will typically launch the export document when the import documents are required to be paid. And that is why this new diamond dollar accounts and all those new things have come up. So while we appreciate that you should be the gainer of the exchange movements, but at the same time, you cannot always speculate on that. That's what is my take.
No, absolutely. I think if you ever base your costing or your pricing basis, any kind of foreign exchange gains, I think you are making, a cardinal error. The transaction has to be worth it in itself for the exporter, even before at a conservative exchange rate, rather than build in any kind of gain. We've seen enough challenges that have happened over the years when people do that, and they get themselves into some very, very sticky situations. It happened during the global financial crisis, both with that and with ECBs. And, something that people need to be mindful of.
See, the 97 Asian crisis, people have lost heavily.
Yes.
We were part of that game when we were in the markets.
Right.
And the second point, which I'll say, that if I really look at the total pool of the FCNRB deposits or the lendable foreign currency, as told by Kamath, I don't think that the FC loans are exceeding that. I'm sure there should be gap enough. So there may not be total denial, but there could be some other reason, I feel it.
So, Mr. Kamath, you mentioned, Mr. Tanksale, you mentioned this scheme that has just been announced in March this year, which is the Government of India's remission of duties and taxes on exported products, the RODDEP scheme, that would reimburse taxes and duties to exporters. And this scheme was announced by the government to help exporters become competitive in international markets. It is my belief that because the pandemic had started, people have not been able to really grasp the importance of this scheme. So if you could share some information about the RODDEP scheme and how it works and how exporters can take advantage of this. And if it has actually been operationalized during the pandemic.
This is not yet, fully operationalized. It is intended to, substitute the present merchandise exporters from India scheme, which is popularly called as the MEIS, scheme. Currently, under the MEIS scheme, exporters are incentivized to the extent of 2%, 3%, and 5%, depending on their exports to 3 set of, nations. When the program was introduced by the government, it covered only 4,914, tariff lines. This scheme was expanded later on from time to time, and presently it covers about 8,100 or so, tariff lines. In other words, about 75% of the, total products. The incentive levels were also gradually increased from time to time. But unfortunately, the exports have not grown commensuratively. For example, in financial year 2016, exports from our country were of the order of 310 billion US dollars. And in financial year 2020, the exports are stagnant at 313 billion US dollars. Whereas the expenditure on MEIS scheme has gone up from 20,200 crores to about 45,000 crores. And therefore, the government wanted to have a relook at this. This is not the only reason. World Trade Organization saw it as a direct subsidy scheme which violates the global trade norms. And there were complaints, apparently from other countries as well. The dispute resolution panel of WTO has passed an order that the MEIS scheme, being violative of the world trade rules, has to be withdrawn. This is the background in which the ROTTEP scheme has been announced by the government of India. The rates under this are not announced yet. As you rightly said, instead of a direct subsidy, it is a refund of various types of duties and taxes paid by the exporter on various inputs, fuel, etc., consumed in the manufacturing process. Hopefully, the rates will be announced sooner than later. But the question that is being asked everywhere is, will this scheme equally compensate or equally incentivize the exporters as it is being done under MEIS scheme? It is early days yet, until and unless the names of the sectors to which this scheme is going to be extended or covered, and the rates at which the reimbursement would be made, unless they are announced by the government of India, one cannot hazard a guess. But given the kind of stressful situation prevailing now, I'm sure government of India will weigh various pros and cons and come out with a scheme which does not put the exporters into any kind of loss. This is my ardent hope. Thank you.
Any time frame that we're expecting for this to be?
See, the MEIS scheme is now extended till December 2020.
Okay.
So we have time, another, we are only in the month of August. We have another 4 or 5 months time for the government of India to work out the nitty-gritties of this scheme and come out with the details. Yeah, Mohan.
So I just would like to supplement that as Kamath told about the whole scheme and the time frame, this is the time all the exporters should take up with their respective export promotion councils. And I will request Kaushal, if this article which is there for export incentives of fixing disabilities, it clearly articulates that every trade or every council should come out with the real proper calculations. There, I again repeat that government just cannot afford to, I don't care. Right. Government will care, the system will care for you, but you will have to be very articulative that what really gives you the support in terms of remission under ROTTEP, what can help you and remain price competitive in the markets. So I'll be very happy if you can pull out this article and send it to all the participants of the program, Kaushal.
So this is the Business Standard article from...
this is a Financial Express article from Mr. Sunil Jain on 4th of August.
Fine, sir. We'll do that.
Yeah.
We'll do that. I think we have lots of exporters on this call, obviously, and we have representatives of some EPCs as well. Mr. Sanjeev, the Secretary General or Director General of the AEPC, Apparel Export Promotion Council. He is on this call. He was former DGFT or joint DGFT of East. And I think this is a good sort of message to the councils as well, to try and take this up with the government on behalf of their members, as you suggested, sir. So thank you. want to now, my focus is on export finance, and I know we have a finite amount of time, so I'm trying to push Mr. Kamath and you on those questions. I would like to talk about export financing for a moment. That in this, you have we all know what export factoring is. Export factoring basically allows an intermediary to purchase companies' export receivables and advance cash to their business. So it has several advantages that, especially for SME exporters, it doesn't require any collateral and does not show up on the SME exporter's balance sheet as debt. I mean, that's classic advantages of export factoring. It is very commonly used in other markets. I know I've done work in Sri Lanka, etc., where export factoring for all the garment manufacturers, etc., they're very, very widely used in these markets. Why has export factoring not picked up to a large extent in India?
You are right. Export factoring, in India has not picked up to the extent, it desired. The reasons are very many. Let me summarize some of the important reasons. First, there are a very few limited, factoring companies in our country. There is a CanBank factor, there is a SBI Global Factors, India Factors, IFCI Factors. Of course, ECGC is also, in the field.
Yes.
You can count the, factoring companies on your fingertips. But the export factoring is done largely by only one or two, like, SBI Global Factor. While I do not have the latest data on the volume of factoring, in 2017 or so, our overall, factoring volume in the country was 36,200 crores, of which 90% was domestic and only 10% was, export related. You will be surprised to know where we stand in the, in the global firmament. Against about $700 billion of factoring volumes across the globe, India accounts only for less than 1%.
Correct.
Now, the reasons are, as I mentioned, the players are very, limited. And most of these companies who do factoring, are active in domestic factoring and not in, export factoring. This is reason number one. Reason number two is when it comes to export, factoring, it is without recourse, and there is an import factor overseas who is involved in not only collection but also in credit protection. So credit protection means credit insurance, and it means an extra cost, and therefore, the cost effectiveness also, suffers. The third reason, according to me, is at least amongst the mid-sized and MSME segment, the awareness on factoring is, something which needs a lot of, improvement. The fourth important factor, according to me, is bankers. I'm sorry to say this, bankers themselves do not encourage factoring, because under the RBI norms, this is indirectly, under the RBI norms, every banker has to have an export lending book of not less than 20%. This is not mandatory, but this is the indicative, level. And no bank, according to me, is anywhere near that, level. And if export factoring happens, this cannibalizes the loan book of the, banks to that extent.
Correct.
And therefore, the banks in India do not, encourage. And the next reason is, there was no legal framework for factoring in India for a long, long time. It is only in 2011 that the Factoring Regulation Act 2011 was enacted. And in that sense, it is a very, relatively new legal, framework. Under factoring, you get only about 75 or 80% upfront and the balance, after realization. Or maximum, it can go up to 90%, whereas the banks give 100% upfront. The cost of factoring is also higher because the legal document is through assignment, and assignment, attracts, stamp duty. These are some of the reasons why, according to me, the factoring services in India has not picked up the way it ought to have picked up. I'm sure the volumes will pick up as we go forward, and as awareness, improves.
Correct.
And as the products, go on, reviewing and getting improved over time, this will become more user-friendly, more exporter-friendly. I have no doubt.
I will
Thank you.
only like to supplement what Kamath said is that typically if the export is supported by the pre-shipment credit, then obviously no lender will allow the post-shipment to be allowed to go outside and get his pre-shipment adjusted through the proceeds of the others. Nevertheless, I think the most important part which Mr. Kamath brought into is the cost. Cost not only because it is without recourse. Here the credit information comes into picture. That how many of the exporters who would like to go for a factoring are doing a proper due diligence on their counterparties. I mean,
Right.
this aspect is very, very important, Kaushal, because in the factoring, let me sit you, I used to sit on the board of India Factor when it was a subsidiary of Punjab National Bank, and rightly said, where our whole business was coming only on domestic factoring.
Correct.
But to me, it feels that like the trades is one of the successful platform today for the domestic invoice factoring. I think if the proper awareness is created among the MSMEs and the deemed export, let me tell you, it's very difficult to get the pre-shipment for deemed export. But the deemed export can be factored because the counterparty is in India.
Right, exactly.
And I very strongly recommend that the deemed export should be channelized through the factoring, and factoring should not be seen as a cannibalizer of a business, but factoring should be seen as complementing and supplementing the lender's business. If that kind of environment is created, I very strongly feel that the factoring businesses will grow. I remember me and Kamath used to learn factoring forfeiting when it was introduced in early 90s in the international business.
Right, right. Again, keeping the focus on cash flow, because in the current time, cash flow is absolutely vital. It's always been vital, but right now, and during the pandemic and the new normal for exporters, it's become even more vital. So my next question pertains to export incentives. As we know, exporters are entitled to a host of incentives against their exports, and this is, for example, duty drawback. It takes several months for such export incentives to be received, which impacts the exporter's cash flow. Can exporters get an advance from banks against the export incentives that are due to them? So the government owes me the incentives, but I need the cash right now. Will a bank advance cash against that receivable from the government of export incentives?
Yes, Mr. Kaushal, I do agree that there is a time gap between the entitlement becoming, due and the actual payment by various, authorities involved. There is one, incentive which is called as the duty drawback.
Correct.
Which is nothing but the refund of the excise duty paid on indigenous, materials, or the customs duty paid on imported materials which go into the manufacturing of products which are eventually, exported. The refund of this happens under the duty drawback, scheme. Banks have schemes to lend against duty drawback, entitlements. It can happen. Many of our colleagues may not be knowing. It can happen both at the pre-shipment stage as well as at the post-shipment stage. But banks are generally comfortable to lend at the post-shipment stage because by then the duty drawbacks are ascertainable. The quantity,
Correct.
the amount is, ascertainable. The claims need to be directly lodged with the, customs department, along with the export promotion copy of the shipping bill, the copies of the contract or the LCs, the bill of lading copy, and the custom certified invoice copy and the packing list. These are the documents which needs to be lodged with the, customs for claiming the drawbacks. Because there is a time gap, against the amount that are due and against the amounts which are not declined by the customs department, banks do lend at concessional rate for a period of 90 days at the post-shipment stage. And at the post-shipment stage, it is necessary for the banks to take the ECGC guarantee, which is called as the export finance guarantee, so that in case of non-payment, the bank's risk is covered. Banks normally keep a margin of 25% on the drawbacks. So what may not be known to many people is this can be given at the pre-shipment stage also. Now, at the pre-shipment stage, many a times, the cost of export exceeds the value of contract, and the difference is representing the duty drawbacks or the profit element, small profit margin which the exporter makes on the exports. At this pre-shipment stage, we are not aware of what amount of duties will eventually be paid, and therefore, because there are no documents to prove the entitlement at the pre-shipment stage, therefore banks keep a higher margin of 50%, not 25%, and again give advance at concessional rate only up to 90 days, and this happens against ECGC guarantee to the banks called as the export production guarantee. And in the event of non-payment, subject of course to compliance of the terms and condition, ECGC looks at the possibilities of honoring the claim. So duty drawback is one incentive against which banks do have schemes to lend.
Right.
Thank you.
Right. Thanks.
So Kaushal, I would like to supplement here. While the credit against the duty drawback is one part of a story, today the way entire documentation has got digitized, all the exporters community, they know very well that all documents, the moment it is exported, they are on the EDPMS. See, there is a platform called EDPMS and IDPMS, which is purely for the exporter and importer, and the customs have got the complete access to it, bankers have access to it, RBI has an access to it. Now, having created such a strong platform, incidentally, I was again a part of that platform creation. I will rather appeal that while it is the duties related to the pre-shipment stage, the rod tape should take care of it. Why at all the duty should be levied on the exporters while he's paying for the goods?
Correct.
Let it be, since it is going to be waived. I mean, these are the inputs which I am giving for the export promotion councils, and they should take it to FIO. I know they are very strong. I lost my good friend, Mr. Ganesh Gupta, who used to be very vocal, and I used to give him all these inputs. So, under rod tape, can you really cover that? And on the post shipment, when I'm putting all information on the EDPMS, what else is required? You just process it and pay me back. It should not be more than a week's time for me to receive my duties at all. I mean, that should be the demand which should flow. While your demand with the banker should continue, I mean, we as a banker are not shifting you, but we as a banker are also telling you the ways and means to expedite to get your cash in hand. Because I totally agree, today cash flow management is the biggest challenge for them. And thus this suggestion could jolly well go from the promotion councils for both the sides, pre, rod tape, post, EDPMS. And
Thank you. I think that's very, very practical. And again, a note for all exporters to take up with their councils. We have about 10 minutes left and lots to cover, but I'm going to try and again keep us focused on the financing side of it. The RBI runs a gold card scheme that envisages certain additional benefits to exporters based on their record of performance. Under this scheme, depending on their creditworthiness, their track record, exporters who hold gold cards are granted better terms of credit with faster delivery of credit facilities. So timely credit when it is required and quick, which is critical in an export transaction. Can you tell us more, please, about the RBI's gold card scheme and its benefits for exporters, and how successful this scheme has been in helping Indian exporters so far?
Well, this gold card scheme for the first time came into being in 2003, 2004 foreign trade policy. This gold card scheme envisages certain additional benefits to the exporter community. Individual banks can set the eligibility criteria, and accordingly individual banks have decided what are the eligibility parameters. Apart from being a very credit worthy exporter, one should have a good track record also to be eligible for the gold card scheme benefits. They should not be on the RBI's caution list or on the ECGC's specific approval list. Some banks also have kept a condition that the overdue exports should not be more than 10% of the actual exports of the previous year, so on and so forth. Now, what are the benefits under this scheme? The benefit largely are as under. One is the banks may consider lower interest rate and lower service charges and various fee schedules which the export activities attracts. This is number one. Number two is that the limits can be sanctioned for a period of 3 years instead of 1 year, with a proviso for step up or step down depending on the actual performance of the exporter in a given financial year. There is also a proviso for sanction of 20% additional working capital limits for the exporter in scenarios like bunched exports, port congestion, exports not taking place, so on and so forth. This is very critical for the ongoing export activities of the exporter. In the case of seasonal activities, seasonal commodities, particularly the agro export lines, there is specific provision for fixing peak level limits and off-season kind of limits, so that there is no one size fit all kind of a scenario in the case of limits. You mentioned about timely sanction, turnaround time for sanction, which is very critical in today's context for exporters. Therefore, under the gold card scheme, the limits which are new, applications for new limits have to be decided within a period of 25 days. Ad hoc limits requests should be decided upon in 15 days, and renewals in 7 days time kind of time frame, which is half the time which is allotted for normal sanctions under the normal limit. Preference should also be given to the exporters for sanctioning of foreign currency related denominated pre-shipment and post-shipment limits. In deserving cases, term loans for setting up of factories can also be given in foreign currency, instead of Indian rupees. And last but not the least, I have kept this to the last. The necessity for collateral securities can be waived by the individual banks, based on their credit judgment. But this is easier said than done in banks today. In the stressed situation, may need their own additional comforts. So this is broadly what the gold card scheme brings to the table. Thank you.
So I would just supplement that there is one more facility, like the export documents can be sent directly to the overseas importer. That itself, again, a very big facility which is available to the gold card. But my suggestion to the exporter community is that you are all aware of the various schemes of various banks. Now the responsibility is on you, that how can you really raise your standards to reach the expectations of the bank scheme and command to be a gold card holder. So these are the indications on which you can work, and if you feel your bank is very stringent on something and other bank is liberal, you can always represent to the bank that, well, these are the difference, because as rightly said by Kamath sir, that the scheme will be decided by the individual bank with their own parameters. But by and large, the parameters will be on the same footings, I believe. Yes.
I'm glad you mentioned earlier about the RODTEP. We've got some good news from Mr. Nandwani, as I said, from AEPC. And he has written that the suggestion on RODTEP is very well taken. The exercise of industry consultation through EPCs has been initiated by the Department of Revenue, and that we would be very happy to take these inputs forward. And this is from the Office of Joint Secretary Drawback of the Department of Revenue. Started, and I'm glad. I mean, this is the kind of dialogue Rubix loves facilitating, because it really is actionable. So thank you, Sanjeev, for that. Unfortunately, I can't unmute you. Otherwise, but I promise we will get you on when you are available for a chat. But I think that's great news that the scheme is beginning to work. Like I said, now about 8 minutes left. I'm going to ask you one question, again related to cash flow in this time. Exporters need every penny to help their cash. In transactions for several commodities, exporters are required to draw bills on overseas buyers for a 90 to 98% of the FOB value of the contract. And the residuary amount is called the undrawn balance, which the overseas buyers pays after satisfying himself or herself about the quality and quantity of goods. Similarly, so you have this one is this undrawn balance, issue. Similarly, in the case of turnkey projects or construction contracts, project exports, basically, overseas companies retain a percentage as retention money, and sometimes it can be sizable in dollar terms, which is payable after expiry of the stipulated amount of contract completion. Can exporters get bank finance for the undrawn balances on export bills and retention money that they currently don't have access to?
Yes, banks do lend against both undrawn balances as well as retention money. Briefly, under the Foreign Exchange Management Act, 10% can be the maximum amount of undrawn balance, and it doesn't happen in all kinds of trade. Only in those cases where the actual amount payable is ascertainable only on quality check, quantity check. For example, agricultural produce, where there is a loss of moisture and therefore the weight comes down, as an example to be quoted for better understanding. In all such cases, small percentage of the overall contract value is left undrawn, even though the full amount is declared in the EDF or the GR form, as the case may be. And the invoice along with the export bill is drawn for the net amount, gross less undrawn balance. Such undrawn balances, as you rightly mentioned, get accumulated and affects the cash flow of the exporter. These undrawn balances must be realized within a maximum period of 9 months currently. Earlier it used to be 6 months or so. Against these accumulated undrawn balances, banks do lend to the extent of about 75% for a period of 90 days at concessional interest rates. The documentation is an application formal and copies of your export document or the documentation related information. When it comes to the retention money, yes, retention money largely happens in the case of supply contracts covering engineering goods, and as you rightly mentioned, in turnkey and construction contracts. Banks have scheme to lend against the retention money in the case of supply of engineering goods, again on similar lines for a period of 90 days, at concessional rate. With regard to the turnkey projects and the civil construction contracts, which also forms part of the what we call as project exports. The amounts involved are fairly large, and it is all subject to the project becoming operational, there being no hiccups, etc., etc. The preferred route which the banks would like to adopt is to issue guarantee for release of
absolutely
retention money. There is proviso for issuance of such guarantees in the project export manual, which has come out from RBI and the Exim Bank, etc., etc. And this guarantee route could be adopted. Ultimately, what matters is cash flows. The release of retention money, whether it is fund based or non-fund based, doesn't matter greatly. So these are ways and means how the exporters can generate cash flows against the monies which are held up.
So I very strongly support Kamath with regard to using the guarantee. In any case, it is a performance related activity or quality related activity. So if you can ask your principals to release the money against a bank's guarantee, and if these guarantees are covered under the ECGC or so, I think it will be a cost effective borrowing or methodology for the exporters to receive their cash in time. So again, I think there is a room for, while it is very much prevalent in the project export, on the other side, the guarantee is not that prevalent. But if the guarantee can be issued and if the principals are ready to release against the guarantee, I think that is the best way to go about.
Thank you, sir. So we've got lots of questions coming in. I think lots of people still live on the webinar after an hour, which shows how interesting this topic is. One question that has come in from Mr. Param is, what are the banking facilities available for deemed exports?
Well, deemed export, as Mr. Mohan mentioned, are exports to the local entities, which means that the goods do not leave the boundaries of our country. It is also a mechanism of import substitution, which means that the foreign currency doesn't go out of the country. Chapter 8 in the foreign trade policy deals with deemed exports. I will tell a few examples of deemed exports for the benefit of the listeners. Supplies made under the advance license is one category. Supplies made to the 100% export-oriented units, software technology parks, electronic hardware technology parks, and biotechnology parks also rank as deemed exports. Supply of capital goods under the EPCG scheme, sourcing of capital goods locally again ranks as deemed exports. Supplies made to projects funded by multilateral, bilateral, lending institutions under international competitive bidding. Similarly, supplies made to the fertilizer plants, the power plants, the nuclear power plants, project funded by the UN, related organizations, all rank as deemed exports. Now, under the deemed export, pre-shipment finance can jolly well be given by the banks to the deemed exporters, as per the normal terms and conditions governing the pre-shipment lending policy. But when it comes to the post-shipment, the tenor is restricted to 30 days because the repayment or the payment of these bills must come from the local agencies. That is the only difference. Otherwise, pre-shipment as usual, post-shipment for a maximum period of 30 days. And again, the exporters would be happy to know this can also be given in foreign currency, both pre-shipment as well as briefly, this is what pertains to deemed exports.
Thank you. Mr. Tanksale, anything to add on that?
No, I will only say that the special economic zone or the international financial center, that is like GIFT City, which has been created in Ahmedabad, Mumbai, we have got the benefit of SIPs. I mean, these are the areas. Likewise, there are a number of SEZs operating in the country. So the exporters should see that if they are exporting it to the manufacturer in these, there is automatic benefit to the domestic supplier that it is considered to be deemed export, because what is deemed is that instead of you exporting directly, it is getting indirectly exported by the exporter. So I think there are huge opportunities which one must explore.
So there's a question from Mr. Manoj Acharya, and his query is that can exporters take post-shipment loans and pre-shipment loans, purchase order, under merchanting trade transactions? And as a bank, what documents can we request from the customer? I think Mr. Acharya is a banker. How much tenor can we grant the loans?
For merchanting exports, what actually it means is an Indian exporter will import from a third country, and that third country will directly ship the goods to the destination country where the buyer resides. There are provisions under which we can give both suppliers credit as well as buyers credit to the merchant exporters. Well, buyer's credit is something which has to be given, overseas. Supplier's credit is what is being given by the Indian exporter directly to the, ultimate. But they are not eligible for, packing credit. Merchanting trade is not eligible for packing credit simply because there are no goods here.
Right. Right.
But there are, various provisions in the FEMA. Which governs the way the merchanting trade is to be done.
Right.
But
so
opening just a minute. Opening of letter of credit for the import leg is absolutely possible. Merchanting trade normally is done against either full or part advance payment for the export leg, or at least irrevocable confirmed letter of credit if you want to mitigate your risk involved in merchanting trade, which is much higher risk than in a normal export import trade. Correct. Because of three countries they are involved. You are also permitted to make advance payment on the import leg, provided above a cutoff you get a bank guarantee or a standby letter of credit from But unfortunately, as things stand today, merchanting trade doesn't rank for availment of pre-shipment credit. Thank you.
No, I just wanted to supplement. Correctly said, merchanting trade is basically on a back-to-back basis. So on the terms on which you are exporting to a third party, you are importing from somebody. So if the terms of the exporters are taken care of by your LC opening or kind of guarantee funding as told by Kamath, I think merchanting trade is being supported by the bankers for all the purposes. I don't see any difficulty.
Thank you. Thank you. My last point, and it's more a point sort of question also, as you know, risks are very high during a period like this, a pandemic like this. Three kinds of risks. You have your fraud risks, of course, which always, fraudsters love such periods in which to create chaos and try and enrich themselves at the expense of others fraudulently. The second is forex risk. Just for example, the rupee has depreciated against both the euro and the British pound by approximately 10% since March 15th alone. So you have a forex risk. And the third risk, where we at Rubix shout ourselves hoarse, is essentially around credit risk. During, normal times also, but now even more so, where you're seeing massive amount of bankruptcies in overseas markets. So whether it's a JC Penney, whether it's a Debenham, whether it's a Pier 1, you're seeing massive names going into Chapter 11 or some kind of bankruptcy protection depending on the jurisdiction. What is your advice as senior bankers, as someone who's been in, both of you have been in this situation many times before, what is your advice to exporters? How do you manage fraud risk, currency risk, forex risk, and third is, of course, credit risk during these times? This will be my final question. We still have lots more, but I will have to let you go. We have exceeded our time substantially. This is our first webinar that has gone this long. So it just shows the interest in the topic. Everyone wants financing easily and finance.
Kaushal, you have actually, rolled 3 or 4 questions into one. So therefore, let me answer one by one. First is the, fraud risk. Fraud risk against Indian exporter normally, ultimately leads to, default and loss of, resources either to the exporter or to exporters, banker. And therefore, there is a dire need to know the antecedents of the overseas, buyer. It is absolutely essential to make sure that the overseas buyer is worthy, of taking a risk on him. Now, credit worthiness has 2 components. One is the ability to pay, and the second is the willingness to pay. Now, ability to pay is something which can be, determined based on his financials, his, sales, his profits, his capital, his dividend payment, track records, so on and so forth. You can also call for, reports from the, Indian embassies overseas, from credit information agencies like, Rubix, social media reports, so on and, so forth. But on the willingness to pay, there is not much to depend upon except in the basic aspects of the overseas buyer, which is reflected in the transactions, analysis. What is his payment track record? Have there been defaults? Have there been, instances of, repeated delays? Here again, agencies like Rubix or other credit information agencies, including ECGC, can play an extremely important, role. A couple of points for the benefit of exporter is that somebody who is new in the export field, getting large export, orders, must put him on the guard. Somebody who offers disproportionately high unit price, you should be doubly sure that there is something fishy. Overseas buyers' address is care of post box or is nothing but a shell company, should put you on, extra guard. Exporting to high risk, countries. Exporting to countries with externalization problem means they have foreign exchange related, problems. Countries at war, countries having geopolitical tensions, countries, which are in high seismic zones or prone to, natural calamities, so on and so forth. These are the, precautions which the, exporters need to take against possible frauds or possible, defaults. What are the mitigants? One is importers' due diligence, to which Mohan referred to, earlier. This must be done in great length with the help of the credit information, agencies. The exporter can seek irrevocable letter of credit or advance payment, or seek payment against a mere, scanned copy of the, bill of lading, so on and so forth. But the most important thing is that either based on the advice of the, credit information agency or on, on self-volition, if an exporter is dealing with multiple, importers, there is a dire need to keep a risk limit on individual, importers. Whether it is on document against payment or whether it is, usance basis, there is a need to exercise caution. And as a good risk management, process, there is a need to fix, risk limits. This is based on, this is with regard to the fraud risk, and the credit risk, both together. Now, coming to the last point on, exchange, risk. It's an inherent risk in any international, trade. The exchange rate may, change adversely or to your benefit. If it changes adversely, the exporter will earn less revenue. The importer will, has to meet a higher cost. So therefore, what do we do? I, as a very, old school of thought banker, use to recommend only forward exchange contracts. Purchase contracts for exports and sale contracts for, imports and other related, activities. Well, forward contract in itself is a big, topic. Without going into the details, this is what, in my view, the exporters, should resort to. There are, of course, currency options, currency futures, so on and so forth, which has brought grief to many, exporters, because there is no appreciation of the risk involved in this. During our tenure of active service in the banking, we have seen somebody speculating on the exchange risk, making handsome money in 1 year and losing double the amount, the next year. My only advice to the exporter is, your core earnings must come from your core activity, which business is export, and not through speculation. Exchange rate is not meant to be, speculated. If one speculates unduly without having the appreciation of the risks involved, will come to grief at one or the other point in, time. And therefore, my advice is, be careful, hedge your risks properly. Now, somebody might ask, by hedging, do I not lose the upside? Yes. But your downside is also protected. When people ask me this question when I was in active service, I used to say, hedge 60-70%, leave the balance, 20-30% unhedged. So a major portion of your downside is covered, whereas a small portion is available to you to encash your upside. This is my personal view, which I used to, share with my, export-import clients. I repeat the same here. Don't take me as the gospel truth. This is individual, views and opinions. Thank you, Kaushal.
Thank you, Mr. Tanksale, sir.
Yeah, so I would like to add here that all of us today know that we are living in an era of VUCA, VUCA, that is volatility, uncertainty, complexity, and ambiguity. Having said that, the risk, what Mr. Kamath has defined, is dynamic today. It is not static that you take one report once and it is taken care of. So my first suggestion will be that one is that there are enough risk mitigants which are available. But before I talk of risk mitigants, you have to appreciate the risk, possible risk of different kinds in your transactions. It could be different for a different kind of transaction. But there is a great need to appreciate the risk. And I'll take one more minute here. I was being interviewed by the Jeev Walker of Asianomics. That was way back in 2010, if I'm not wrong. And I was ED Financial Bank. And my numbers were on the rooftop. All efficiency numbers of financial banker on the rooftop. And country was claiming to have a resilient economy. And believe me, 45 minutes, my interview, I was positive. After having a cup of tea, when he left my room or he was leaving the room, he said, Mr. Tanksale, all is well with you. My only piece of advice, please do not forget to appreciate the risk which is dynamic. And I never forget that. So everybody who is in the business has to understand we are in a period of VUCA. Appreciation of risk has to be there. You should perceive the possible risk. The possible risk mitigants are available. And then, as rightly told by Kamath, that to some extent you can mitigate your risk. You can do the hedging part of it. To some extent, you can keep it open, have the benefits of the upsides or whatever downsides if you are importer, downside if you are exporter, upside. So whatever it is, my request is that if this today, luckily, you have got the databases available, data science companies. I will not say Rubix because I am a chairman of a company, but there are n number of avenues which are available, particularly the agencies which are in a position to process the data for you and which are in a position to predict the probability through the credit scores. I think those things will have to be seen by the exporters in the change scenario. And if that is taken care of, I only repeat two things. Compliments. It is the exporters community who have really today, after 18 years, you are saying trade surplus. Of course, it is because of the import denominator has also come down. But we can't undermine the performance of the exporter. We have seen in early 90s it was minuscule, and today whatever is there is there. Second is that all the stakeholders who would like the exports to go up will support you, will support your endeavors. The only thing you will have to evolve and make sure that you are really globally the most preferred supplier. I think with these best wishes, I'll say thank you very much. All the very best. Wonderful, Kamath. I enjoyed and was recalling our old days when we used to debate on various issues because both were a part of International Banking for almost 10 years in Union Bank of India. Thank you, Kaushal, for this opportunity.
Thank you. So, as I conclude,
I think Kamath wants to say something.
Yes, I was just, yes.
No, before you formally conclude, Kaushal, thank you for having me on the webinar. And my best wishes to all the participants, all the listeners. In difficult times, may God be with you. Continue to do well and make country proud. Thank you.
Thank you. Thank you so much, both of you, for what I think is a masterclass. It was a masterclass on export financing from practitioners at the highest level. I think lots of takeaways for all of us. One key one, of course, being don't be greedy and reckless during this time. There are lots of avenues available. I think we have to push export promotion councils, push our own teams to talk to banks, to try and see what schemes are available and leverage those. There are plenty available, as Mr. Kamath said, and Mr. Tanksale elucidated. I think it was a very, very powerful session for us. The fact that we could go on for 1.5 hours with all our attendees is testimony to that. So thank you, both of you. All of us at Rubix really appreciate it. For exporters, Rubix is always here for anything that you need in terms of predictive science or information about overseas buyers, their transactions, or domestic companies. We work with ECGC, we work with several banks, and we work with some of the largest export companies and domestic companies in India as well, and helping them assess credit, supply chain, and compliance risks. So we'll be happy to help you in that endeavor of yours to keep free and safe during these VUCA times, as Mr. Tanksale said. With that, I want to conclude this seminar. Thank you again, Mr. Kamath, Mr. Tanksale. Fabulous session. Thank you, everyone. Stay safe until next time. And we will have information about our next webinar up very soon. So thank you and stay tuned. Bye.
Thank you.
Thank you. Thank you. All the best to everybody.
Thank you, sir.